a very, very special guest. This is the beginning of a new series of interviews that we're going to be conducting with high level executives, very accomplished entrepreneurs. And we couldn't start this new series with a better guest, Mr. Mike Weinbach. He's going to be joining us today. We're going to leave a few, less than a minute to let some people to join us before we start the conversation. But Mike, welcome and thank you very much for joining us today.
Yeah, Tide, thanks for having me. And on behalf of all of Wells Fargo, it's an honor to be able to partner with the Hispanic Chamber of E-commerce and looking forward to the conversation.
Thank you so much, Mike. So Mike Weinbach, he's the Senior Executive Vice President, CEO of Consumer Lending at Wells Fargo. He has an amazing career, but instead of me reading his bio, and if it is okay with you, Mike, I would like to walk through your successful career, and we're going to be addressing some topics that are going to be that I think are going to be very relevant to our audience. And since we already have some folks joining us in, I would like to start this conversation, Mike, with talking about your education. You have a business degree from the University of Pennsylvania and an MBA from Harvard. How important it is education for you and for anyone else that is trying to pursue a career in business or a professional career like yourself?
Yeah, so it's thanks, Tide. And when you mention some of the places I was educated, I sometimes describe it as obnoxiously overeducated, but I do think education is really important. For me, it started as a kid from my dad telling me about the stock market and getting interested. And by the time I went to college, I knew I wanted to study business and I knew my future was in business. All that being said, I did have the benefit of going to some great schools. I got to meet great people along the way. But one of the things that I learned is some of it is what you learn in the classroom, and some of it is what you learn out of the classroom.
Mm-hmm.
And some of the best educational experiences I had were working and trying to start businesses and making mistakes. You know, honestly, like education is critically important. Sometimes the best teacher is your most recent mistake. And if you really want to get better and be the best you can be and are motivated that way, education happens and growth happens.
You know, my dad used to tell me that the best thing that they could leave us, my brothers and I, was over education. I have a bachelor's degree in economics and a master's degree in marketing. So I agree with every single word that you're saying. And every time that we can, that's the message that we communicate to our membership at the Hispanic Chamber of E-commerce. And that's why we invest so much time in seminars and workshops, because we never stop learning. Don't you agree?
I totally agree. And look, and I know anyone who's watching agrees too, or else they wouldn't be here because you're taking some time to get some new perspectives and learn some things. What's amazing about the world today is there's so many more options and opportunities to learn. Some of the courses that are available online, whether it's, you know, the Khan Academy or Coursera or some of the other programs, it's an all-you-can-eat buffet in terms of education. It's just how much time you have and how much motivation you have for it.
That is correct. So let me ask you something. I know that you started a business before you started your very successful career in corporate America. And I would like to talk a little bit about that because you were part of the dot-com bubble, right?
Yeah, yeah. I
So,
so am I, yeah. You want
uh,
me to tell a little bit of
yeah,
the
like
story?
I wanna tell the audience that you are an entrepreneur at heart that happens to be working in corporate America, because that is something that I truly believe in, Mike. You never get rid of that entrepreneurial spirit, and I think you have it.
Well, you describe me as a very successful entrepreneur and executive, and I might be a more successful executive than entrepreneur. but I'll tell you, I'll tell the story a little bit, which is, after I graduated from college, I actually went to work at a big bank that's now part of Citigroup in investment banking. And I had one of those great, 2-year programs where you get 4 years of experience because you're working 80 to 100 hours a week. You just get it compressed. And then after that, I went to work for our parent company, was involved in some of the mergers and acquisitions the company did. And I applied to go to business school. This is now the late 90s. And the
Okay.
only thing I knew for sure when I was going to business school was I'd done the big bank thing. I was never going to work at a big bank again. And I wanted to do something entrepreneurial. And it was, it was the early days of the internet. It was before it was, I guess, during the dot-com bubble, before the
Yeah.
bubble burst. And while I was in business school, I started a business with a classmate. We raised money from friends and family. We raised about $1 million. And by the time we graduated, we had launched a website called You Inspire, which had built the world's largest database of inspirational, motivational content,
Oh,
which
wow.
was something I was always passionate about, growing up in athletics and reading the wise words of people who come before me and igniting that spark within, and wanted to share that with the world. And it was a great experience. I mean, we launched our website. We had hundreds of thousands of users, and but we rode the dot-com wave up and rode the dot-com wave down. So in a period of about 3 months, our CPMs, what we were getting paid per 1,000 visits to the site, went from $40 to $2. So a very significant decline in our revenue model. And then we started doing different things and changing, and we started publishing our content into books. And it turned out that was a hard way to make a business work. And then finally, we started doing some consulting for other businesses on how to motivate their workforce, and ultimately ended up running a consulting firm and making a little bit of money doing it. But before deciding that it wasn't like everything we had set out to be, and wound the company down. And like, lo and behold, I ended up back at a big bank.
So let me go back a little bit because you mentioned that you raise money from friends and family, and this is something that I tell a lot of entrepreneurs that are coming our way, that the first thing that they have to do is just that, raise money from friends and family. Because if you cannot pitch your idea to friends and family, forget about it pitching it to VCs or angel investors. What advice can you give anyone that is planning to start a business right now on how to get that first round of funding and then move to the next one that could be an angel or VC, or go through the traditional financial system, which is a business loan?
Yeah, so there's a lot of different ways to fund a business, but raising equity, or getting money from friends and family, uh, is is often the most realistic
Yeah,
place to start.
I
And
agree.
so what I did is we wrote a business plan, and kind of started with family and expanded to friends and said, this is what we want to do. We had a lot of first, we sent it to a lot of people who said, oh, that's great, but I don't want to talk to you. And then we had a lot of meetings, and not every meeting ended up being somebody wanted to invest. But there were, fortunately, enough people who believed in what we were doing and believed in us that they invested some money and basically bought a ownership share of the company and a share of the future success.
I think when you have a great idea, sooner than later, a door is going to open up for you. You just have to be consistent and disciplined in your capacity of going after some funding out there. And what you just described is exactly, you know, the stuff that I tell to a lot of the people that come our way. When your company you inspired uh, didn't make it, or I don't want to say fail, but it was part of the dot-com bubble. I read that you help a lot of your employees to uh, get hired by some of your clients, and that was a
Yeah.
priority for you. What was that?
Well, there's a few. So one, at the time, I really did feel like we failed. I don't feel that way now looking back, but it
Yeah.
was, people, I raised money from friends and family. And at the end, we gave some back, but it wasn't as much as we started with. So they invested and we were supposed to grow it and we didn't. And I felt really bad about that. But you're right. You've done your homework. We were able to place all of our employees with clients. So while our company didn't continue, there was no one who ended up losing employment as a result of it. And then the other thing, and this really, I didn't understand it at the time. I understand it better now. When I went and told all the investors that we were going to wind the company down and apologized for the fact that we didn't succeed the way we hoped we would, the strangest thing happened, which was most of the investors offered me a job. And I was, why would you want to offer me a job? I
I
just
failed.
failed for you. And the response was, well, I've invested in a lot of companies during this period, and a lot of them failed, but most of them didn't fail as well as you did. And so there were a few things. I sent a weekly newsletter to my investor, sorry, not weekly, monthly newsletter to my investors every month. I told them exactly what was happening with the company, what I felt good about, what I didn't feel good
So you were
about.
very transparent.
Yeah, I gave them insight into the way we were thinking about their investment, because really I work for them, even though it's technically the CEO or president of the company,
Yeah.
and they appreciated that. And some of my investors worked at a bank called Bank One, which I ended up joining, which got me back into banking. And then Bank One got bought by JP Morgan Chase, and I was there for 16 and a half years before coming to Wells Fargo earlier this year.
There is one quote that I found that you mentioned a while back, and you said, while you cannot always control the outcome, you can always control the way you handle yourself, and that's what people remember. I love it, Mike. Can you elaborate a little more on that?
Yeah, well, I mean that's again, I'm impressed by the research you've done. But yes, there's a lot of things in life that happen that are outside of your control, and it's easy to let yourself get derailed or put in a tailspin by those things that are outside of your control. But it's important to remember there's always things that are in your control. And one of the most important things is the way you treat other people. And you can always control that. And I think if you do the right thing and treat people the right way, even if circumstances don't always go your way, in the long run, people remember it.
Mm-hmm.
And that's where most of the opportunities that I've had ended up coming from. And in the position I'm in now, I have about 50,000 people that work for me. I have a lot of employees, and I get when we're deciding who to give opportunities to, it's not, you don't just say, okay, who had the best numbers? That's the person who's the right one to lead.
Mm-hmm.
You look at what people accomplished, but you also look at how they accomplished it, the what and the how. And you can always control the how. And if you do that right, people will notice.
That's true. And I want to go back to the 50,000 people because that's pretty impressive, Mike. Um, you mentioned that you started your or restarted your banking career in 2003 with Bank One. And after that, you became the CFO of company's consumer banking business for the company. So, in regards to career growth, because we have a lot of professionals that follow us and actually are members of the Hispanic Chamber of E-commerce and the U.S. Business Association of E-commerce, you talk about the importance of uh, lateral movement, and I would like you to talk a little more about that. Like, what advice can you give someone that is just starting in any industry, those young professionals that follow our channel? What advice can you give them to start pursuing those positions within the company or the industries that they are currently working on?
So we talked earlier about the importance of education,
Mm-hmm.
and when I went to college, I'm sure for all of us that had the opportunity to pursue higher education, you have to pay for it. And while you're in school, you're giving up the opportunity to work and other things. So whether you're paying directly or it's an opportunity cost, you're paying, but it's an investment you're making in yourself. As you learn more things, you're going to get better. That's going to make you better. It's going to lead to future opportunities. A lot of times people make the mistake that when they get into the workforce, they get into the corporate world, they view it as, okay, now I need to climb the corporate ladder and everything. I need to do the job and then get a promotion, and miss the fact that there's often this incredible opportunity to do something different within the same company,
Mm-hmm.
where you're really getting an education in that new function or that new business or that new area. But instead of having to pay for the education like you did in college, you actually get paid to do it, and usually paid the same amount. You don't even have to get paid less, even though you're learning more. So in my career in banking, one of the things that probably distinguished me was a willingness to do different things. So I moved from business banking sales to consumer banking finance, back to a sales position in business banking, to a finance position in our auto finance business, to managing bank branches, to moving into the mortgage business, running operations, and then ultimately had the opportunity to run the home lending business at Chase, and now all consumer lending at Wells Fargo. But if I didn't do all of those different things, each one of which was hard because you're going into a new area where you don't know as much, you have to work twice as hard to get up to speed, I wouldn't have had the opportunities that I have today. So I encourage everyone who's in the corporate world or working in any business, when there's an opportunity to take on something new, make sure you recognize what a gift it is in terms of the opportunity to continue to further your education.
So bottom line, guys, lateral moves are better for your career than promotions. Right, Mike?
Yes. Yes, and I apologize. I'm getting up to open the door because my dog is scratching at it, and
That's okay.
she'll be very distracting.
It happens in these days of the pandemic where we're handling this type of meetings. But Mike, it sounds like you're a very patient man, and I think like it sounds by the sound of what you're sharing with those that you always have had a strategy, whether in business or in your executive career. And I think it is important for anyone watching this interview to keep that in mind. I mean, Rome wasn't built in one day, right? And
Yeah.
what what we're learning from Mike today is like he took the time to learn the skills that put him in the position where he is it right now, right, Mike?
Absolutely. And I'll add, like, while I often had a strategy, it rarely played out the way I thought it would.
Mm.
So it's important to have a strategy because you always want to be thinking about what the opportunities are, what the next move is, but you also need to be flexible based on
Correct.
circumstances. And most of the time so in any job I had, if you said, what's your next job going to be? I would have given you an answer and it would have ended up being wrong. But by staying flexible and open to opportunity, when the opportunities came, I've been able to take advantage of them, and that's helped create that learning mode. So again, important to have a strategy, but if you're going to write the strategy down, instead of writing it in a marker that can't be erased, write it with a number 2 pencil with a good eraser,
Yeah.
and always edit it and make it better.
Great advice. Thank you. Thank you so much for sharing. So now, under your current position, you are in charge of home lending, auto lending, credit cards and merchant services, education finance, and personal loans at Wells Fargo. So it's a huge responsibility. So you said you are in charge of 50,000 people?
Yeah, we have about 50,000 team members that help. And it's, I mean, they're great businesses because the core of what we do is we help make our customers' dreams come true. Whether your dream is to own a home or a car or take a vacation with your family or build a swimming pool in your backyard because it's hot and there's a pandemic and you can't go to the, the town
Yeah.
pool anymore. That's what we enable with the loans we make to our customers. So it's yeah, it's a great responsibility.
You know, oftentimes I ask some of the members of our association, like, what are some of the goals that they want to accomplish as entrepreneurs, as business owners? And for a lot of them, one of the common answers is that they want to buy a house, they want to own a home. And if you live in California, New York, you know that's a big accomplishment because it is not cheap to own a home in these states. Um, so it is one of the most important financial decisions for professionals and business owners. What advice can you give them to put together a profile that is going to qualify them to buy that home, and a home that is not going to put them in a financial constraint where the business is going to suffer or their personal finances are going to suffer? You have seen it all, Mike. So what can you share in that regard?
Yeah, well, look, I think that the great thing about owning a home versus renting is when you pay your monthly mortgage payment as a homeowner, part of that payment is paying yourself
Mm-hmm.
because you're paying down some of the principal on the loan. So owning a home is a great way to build wealth and equity in the home. But whatever, whether it's a home, a car, a business, you want to only you want to only buy something that you can afford to pay. You don't want to put yourself in a situation where you're not going to be able to. I can tell you the way a lender is going to look at an application for a mortgage is the credit score is very important. So I'd encourage everybody out there, know your credit score. It's very easy to keep track of it. If you're a Wells Fargo customer and you have any account with Wells Fargo, you can go on our website. We have a program where you can see your FICO score, which basically your credit score. But and most banks have that. And if you're not with the bank that has it, a site like Credit Karma or something like that, I'll be able to
Uh-huh.
provide the information. But you want to have a credit score that starts with that's 700 or higher. The rates will be lower, your likelihood, the interest rates you pay will be lower, the likelihood of being approved will be higher. If you don't have a credit score that's that high, there are a lot of tools to understand how to rebuild your credit. So I really encourage you, if you're not familiar with how credit scoring works, it's not as complicated as it might sound, and pay attention to that. And then the other thing a lender is going to look at is how much your cash flow, how much money you make, and how much money you need to spend. Because what we want to make sure is we're not going to give you a loan payment you're not going to be able to afford. Owning a home's great, but if you can't make the payments on the home, having it taken from you is a really bad thing that the bank doesn't want to do, and you wouldn't want either. So know your credit score, understand your cash flow. It's something called the debt to income ratio.
Mm-hmm.
And those are probably the main. The last thing I'll say is just, I think sometimes the misconception is that you need to have 20% or more saved for a down payment on a home.
Uh-huh.
And frankly, that's how it was a generation ago. So a lot of, if you ask your parents or your grandparents, they might say, oh, you need to start with 20% down. The average first-time home buyer in the US, it's about 5 or 6% down.
Oh.
So even in California, where the homes can be quite expensive,
Uh-huh.
if it's a $400,000 home, you should be thinking that you probably need 20 or 25,000 for the down payment. It doesn't necessarily have to be 80,000, which would be 20%.
Okay, that's good to know. And speaking of credit, I was reading a report, and also, from what I know from our members, is that the report says 60%, but I'm going to say like 70% of the small businesses that are just starting up, the business owner use personal funds to start the business. And oftentimes, a big percentage of those 70% are using credit cards. So when we're talking about like keeping your credit score, above 700 and stuff, when you're starting a business, it might be a little challenging because you don't have the track record to have access to a business line of credit, and you're gonna jump into your personal savings or credit cards because you really believe that you're gonna make that business happen, right? So when you are in that situation, just give me like one or two recommendations so you don't get too carried away to the point where it's so difficult to go back.
Yeah, well, it's when you're starting a business, it's very hard to get a loan for your business because there's no track record, there's no history,
And
there's
this has
usually
nothing to do with you being Hispanic or not. Listen, it's just the way it
no,
is.
right. And so if you want a loan, it tends to be something that's going to be based on your personal credit, which will be a credit card or a home equity loan or a cash out refinance if you own a home that has some equity in it. And yeah, it's not personal. It's just from the bank's perspective. A lot of new businesses don't succeed, and it's until there's a track record, until there's cash flow that can be evaluated, it's hard to make that business loan. So, but even if that to be able to get that credit card, to be able to get that home equity loan, you still need to have strong credit. So you want to make sure that you're able to pay the minimum amount you need to. If you start missing payments consistently, that's when your credit score starts to fall. And at the time when you need money the most is when it becomes the hardest to get it. So you want to watch it. The hard thing is a business owner is like you want to understand what the value of the money is. So if you're developing a product and it costs money for raw materials and it's going to cost you $100 to make that product, if you know you could sell it in the future for $200, if you have to pay 10% interest, that's not a problem. You can cover it later. You'll be able to pay the money back. If you're gonna sell the product that costs you $100 for $105 and you're paying 10% interest, well, you're really losing money then on the sale, and that's a business model you want to avoid. So
So
it's a little bit of
your advice right here, Mike, is that we really need to understand our numbers. And because oftentimes we just go by heart, like, oh, I know that this is gonna sell for whatever, but we are not doing like competitive analysis or market research to see what our competitors are selling their products for, etc. So we come up with a price that it might not be that competitive, and that where we start like having some of these issues that you're mentioning.
Yeah, that's right. It's know your numbers, and part of your numbers are your cash flow.
Yeah, okay.
And cash flow is not just how much money you have, it's how long when money goes out, how quickly it goes out, and when money comes in, how long it takes to come in. So even at Harvard Business School, the very first class you take in finance is if you run a business, job number one is make sure you don't run out of cash. And we do a case study about a business that developed a product that people really liked. And so there were lots of orders coming in for the product, but they had to pay for the supplies in advance. It took time for the supplies to arrive, for the product to be made, for the product to be delivered, and
Mm-hmm.
then they were paid 60 days after the product was delivered. And the product was so good, more and more people wanted it. And eventually what happened is the company just ran out of cash. All the money was going out the door to supply. There wasn't time for it to come in. And then eventually they couldn't deliver the products to customers and nobody wanted them. Things started being returned. The business failed. So that's something with a great product that the business failed because it wasn't able to manage and understand its cash flow.
It's cash flow, correct. So now, quite often I recommend our businesses to start working on their business credit because it's different from the personal credit. How hard it is for a small business or a startup to start working on that business credit when the first financing is coming from their personal credit cards and savings and stuff. Are there any ways that they can start building that business credit from the get-go, even if it's like a small basis?
Well, yeah. So yes, but it does take a little bit of time. So
Like over
for
like more than 18 months, 24 months?
yeah, I'd say usually for a business line of credit, the lender's going to look for 2 years,
Okay.
being in business. So 18 to 24 months today is about the right time frame.
Mm-hmm.
It's still, your personal credit's still going to be important
Yeah.
because the lender is probably going to look for a personal guarantee. So again, your personal credit score, even though it's a loan you're taking for the business, is going to be important. So that's why you want to try and watch the credit score, see if you can keep it 700 or higher. And the lender is going to look at what your cash flow is. And if you have positive cash flow, they expect you'll be able to pay the loan, and you should be able to get a line of credit. And sometimes it's easy to think, I'll worry about that if I need the money. Right now, when I don't need the money, I don't need to worry about building credit for the business. And I think, as you suggest, it is important to think about that early, because the best time to get a loan or a line of credit is before you need it. It's
Exactly.
it's just like umbrellas are most expensive when it starts raining. You buy the umbrella before it rains. It protects you when it starts to rain. You get that line of credit before you really need it, so that when you hit a bump in the road in the business or have an opportunity, you have it there, and it's already set up.
I have another question, and this is in regards to merchant services. It's a very like cloudy industry from my perspective, because sometimes it feels like it's difficult to differentiate, the fees and things like that. So as you probably know, Mike, there are a lot of like restaurant owners in the Latino community and other retail shops that need merchant services. So what are what are some of the things that they need to look into to make sure that what they're getting is what they need for their business and they are not overpaying for credit card transactions and stuff?
Yeah, I'd recommend that you make sure you understand the way the program works. So don't, if it feels like someone's explaining something and it sounds complicated and it's hard to figure out what it's going to cost you for a transaction, you're better off taking the time or finding a provider who's going to provide something that you can understand. So if it's a 2.5% to 3% that gets paid on a purchase where you're accepting credit or debit cards for payment, at least you know what that is, and you can decide whether that's something you can afford to build into your pricing to have the right profit margins. If it requires you to do advanced algebra to be able to figure out what it's actually going to cost you for a transaction, and if it's geared towards potentially charging you a very large amount for a small transaction, and that's not the right model for your business, that's what you want to avoid.
And what do you think about the long-term contracts with merchant service providers when they ask you
Uh,
to sign like 2-3 year contracts and stuff like that?
Yeah, I'm not sure I've got that I have enough expertise to give the right answer. If the provider is going to give you the hardware for you to be able to accept those payments, I can understand why they might look for a little bit more time because they're laying money out up front to provide that
The hardware.
hardware to you. And so that's where it might be okay. If it's something where all you're doing is accepting payments online and you don't need any equipment, it 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 feels less reasonable to commit to a long-term contract.
Okay, so we are getting pretty close to the end of our conversation. We have about 9 minutes, and I want to be extremely respectful of Mike's time because he's super busy. So, if any one of you have any questions, please start sharing them on the chat or Facebook, YouTube, wherever you are watching us. Just share your question. I'm monitoring them. In the meantime, I want to talk briefly, very briefly, before I ask you. I'm seeing a couple of questions there about digital innovation. I know Wells Fargo is going through a transformation right now in terms of the internal processes and the I mean, I'm a user of your mobile app, and I can notice, the changes. It's super easy to make a deposit. Customer service is great. You know that I'm a strong believer in digital innovation, and it's one of the things that we've been carrying. I mean, the flag that we've been carrying for over 12 years here at the Hispanic Chamber of E-commerce. So I want to hear from you how important it is to have the right tools, the right software to make your business more efficient, because this is something that I'm talking about all the time, and just a handful of people out there listen to us.
Well, I'd say you should always expect that your customers are going to expect more. And things they want things to be better, faster, cheaper, smarter, easier. And so if you're feeling like, oh, I've got this and we don't need to improve, there's probably somebody else who's one of your competitors who's working on getting things better. So yeah, I think digital, like the world is becoming more and more digital. Customers are expecting things to be easier and easier. They use Amazon and Google, and when a site doesn't work as well as that, they start to ask why. So I think it's critically important. The great news is, you ever want to know what you should be doing better, just ask your customers. They'll tell you. And so that's the best way to create your roadmap for what you should be focused on. You don't have to sit in an ivory tower and figure it out on your own. Talk to your customers.
So that constant feedback from customers is important. We have one question right here. It's about building a relationship with your banker. We just talked about digital innovation, and it feels, Mike, like we're going in a direction where that personal touch with the banker is going to be minimum. But we also know that in the past, having that relationship with your banker can open up some opportunities for make it a little easier, to have access to capital and stuff. So what can we do as consumers to start building that, and especially as business owners, to start building that relationship with a banker at Wells Fargo or any other financial institution?
Yeah, well, I'm going to answer that two ways. The personal relationship helps because part of that lending decision is evaluating character. They talk about the 5 C's of lending. The first C is character. And character is typically measured by a credit score because that measures how frequently you meet your obligations. But part of it is the in-person piece. But as you point out, the world is becoming increasingly digital. It doesn't mean the relationships aren't important, but the relationships start to be different. Companies are paying attention and your banks are paying attention to the way you interact and your financial habits. And all of that is part of forming the relationship. So if you have if you have a paycheck direct deposited into a bank, then they know that that you've been steadily employed for a long time, and that helps strengthen the relationship. If you have a credit card and you're making the payments and you're consistent with that, even more than your credit score, they know we've had a relationship and you've always done what you've said you're going to do. And that helps create the assessment of character, and that helps strengthen the relationship. So it's both an in-person relationship, and I know this is like a weird thing to say about relationship, but your behavior creates data, which forms a digital relationship, which is important too. And I think it'll be increasingly important going forward.
Perfect. We have another question that is coming in. It says, "Hi, Mike," and this is by Dr. Francisco Valle. "Could you talk more about merchant services regarding how a business could benefit by engaging a company like Wells Fargo to maximize cash flow? Does Wells Fargo offers sweeping services to optimize cash flow?"
So yeah, so what Wells Fargo Merchant Services can help enable your business to accept payments electronically, whether at the point of sale or virtually. And part of the question, I think, was why would a business want that? And I assume many of you are familiar with it, but there's a large body of research that shows that when you accept multiple forms of payment, the sales tends to increase, and the likelihood of the customer being able to make a decision in the moment to purchase your product increases. And then within that, there's you can set up your bank accounts in a number of ways. So sweep options are available, and if you want to separate your operating account from a working capital account, from a savings account, all of that's possible and all of that's available.
Okay, so Rodrigo is asking us. He says like it is. He feels like the credit card environment is too crowded with so many different options, and he's trying to find a credit card for his business. What are some of the recommendations that you give him and others that are looking into getting a business credit card? Based on what factors, like to make a decision?
Yeah. So Rodrigo, you're right. There are a lot of options out there, and it probably depends on what is most important to you and what you want to use the credit card for. So if the credit card is going to help your working capital cycle, so you're going to be carrying a balance for a period of time until you get paid and then are able to pay it off, the most important thing is probably finding a card that has the lowest interest rate, because you're going to be paying interest. If it's a card that you're using for purchases, where you're in a position where you're always going to be able to pay down the balance at the end of the month, then you want one that's going to have the best rewards, and the best rewards for the type of purchases you make. So if you're typically buying office supplies, there'll be cards that have great benefits for buying office supplies. If it's mostly travel or gas or airlines, it'll be different cards that'll have those reward features. So most important thing is to know what's important to you, and then find the card that can meet that. There's no single best card for everybody.
So Guadalupe from Arizona, she's asking us if it makes sense to use a home equity line to finance a business.
Yes, but you want to. It can make sense, but you want to make sure you're not going to put yourself in a position where you put your home at risk, because that's where you and your family live. Most home equity line of credits will allow you to go to 80% of the home's value. So you can't go up to the full value of the home. That helps protect you and helps protect the bank. So yes, we had done a study years ago on the reasons that people use home equity line of credit. Financing a new business was one of the top reasons. And we actually looked at the performance of those loans, how likely customers were to pay them back. And I was happy to see that small business customers and people who invest in their business were some of the best credit, and we're really acting responsibly with it. So it can be a great source of funding, but again, I encourage you to make sure that it's something you're comfortable that you're not going to put your home at risk in doing so.
Mm, that's great to know. Great advice. And we have another question right here from Pedro. He said that he financed his first two trucks with personal auto loans, but now his company is growing. He has a construction company. I'm trying to translate here. It's in Spanish. He has
Yeah.
a construction company, and he's saying like if Wells Fargo offers auto loans for businesses.
Yeah. So the answer is yes, we do typically. We paused for a little bit during the period we're in now for the pandemic,
Okay.
but it is I do recommend if the business is at a point where it can get a business auto loan versus a personal, you get the benefit of being able to write off the purchase and the interest expense against income, which helps you for tax purposes. So, Pedro, it's not uncommon for a business owner to want to get a auto loan through the business, and I encourage you to look at that. And it is something Wells Fargo does typically provide, although we're in a pause right now on that product.
Perfect. Thank you, Mike. So we are on the time limit right now, but I don't want to leave this conversation without asking you one question, and this coming from
Okay.
me. So,
Yeah.
you know, you have an impressive career, and we have learned more about it today. So I want to ask you, Mike, what's the legacy that you want to leave at Wells Fargo? Because you are responsible for a very large business unit at the corporation. What's the legacy that you want to leave at the company?
I just want to make it better than it was when I found it. I want the legacy to be that I helped. I love trying to make things better for our employees and for our customers. There's a lot of elements to my job, but that's what I get most excited about. And so every day it's trying to say, what do we do and how do we make it a little bit better, and how are our people doing, and how do we make people feel better about the work they're doing for our customers. And yeah, I hope when I'm gone people say, we miss him, he helped.
I'm pretty sure they will say that based on you know your career, and it feels like you are very personal, and you have a really good vibe, Mike. So I want to thank you so much for your time today. Is there anything else that you would like to add before we say thank you?
Adios. No, the yeah, I just want to say that, for all the business owners out there, I'm very impressed by you. I like having been through the process of starting a business, and I really think it's one of the most rewarding and foundational things that I've done in my life and in my career. And I know the blood, sweat, toil, tears that goes into running a business. I know when there's small problems, you're the one who's fixing it. And a small business is the backbone of this country.
Mm-hmm.
And so I just want to thank everybody out there for what you're doing each and every day to make your business better, to make your community better, to do great things for your customers. And if Wells Fargo is lucky enough to help you along the way, we really consider it an honor to do so. And Taide, just thank you for having me here. It is an absolute pleasure.
No, thank you so much, Mike. And I want to thank Wells Fargo also for all the support that they have given us over the years. I mean, we're very passionate about the small business community. I mean, you can tell from the work that we've been doing for the last 12 years, but it wouldn't be possible because of your support and you believing in us. And it's not that easy because, you know, when if giving a small business loan to a business that doesn't have any track record, you guys are like, well, maybe we should wait 18, 24 months to see you if you are legit, right? And it took us a lot of time to earn the respect and support from Wells Fargo, and it's something that we don't take it from granted, and I want you to know that. We are extremely grateful for your support, and thanks to everything that Wells Fargo does for the small business community, we're here and we can provide them access to resources and technical assistance and other tools that they are utilizing to stay competitive in the marketplace, not just domestically, but globally. So thank you very much, Mike, for your support. And thank you so much for your time today. I really enjoy our conversation, and I hope that this is not the last time that you pay us a visit.
Yeah, well, thank you very much. I really appreciate it. And wish everybody a great day and stay safe and stay sane in these challenging times.
Excellent. Thank you, Mike. Thank you so much.
Thanks, Heide.
And thank you everyone who watches, and make sure that you share this video because it was a great interview. Thank you, Mike.